Hello, hello, everyone. Welcome to Nature of the Business episode. It's probably 10 at this point. We're on our 10th episode. So, welcome to Nature of the Business. I'm David.
And I'm Monique.
A couple weeks ago, we talked about how to fund your business, and that was really popular. A lot of people were interested in that topic. And so we decided that why not go a little bit deeper on specifically raising angel and seed funding. And I think it's exciting to be talking about this. Part of why we do this at YGN, do this podcast, Nature of the Business, is because a lot of times there's lots of lessons that we just want to share with you guys. And a lot of the things that we've learned, we've had to learn the hard way or on the fly. Raising money is one of those things that's very opaque until you're actually going through the process. You don't know what to do unless you have a mentor or someone else who is running a company who can share that information with you. There's a lot of stuff on the internet that talks about it, but a lot of that stuff is not real. So that's what we want to be talking about today. Monique, you have anything you want to add there?
I'll probably be asking most of the questions because I'm still learning about this space as well. But I know that, David, you've raised and you helped me raise, so you've got a wealth of knowledge to share. So I'm excited to talk about it.
Yeah, me too. Why don't you take it away, Monique?
So why don't we start with why would a company choose to raise money?
Great question. There are a few reasons why you would want to raise specifically investment from angels or seed round. And usually people will say, "Oh, I want to raise some money before I get the product off the ground," or "I want to raise some money because I need to hire these people." I want to raise some money because I need to do marketing for the product. And more likely than not, unless you have some traction and you have some idea of the direction that you're going in, it's probably not the right time to raise funding. The reason why I would raise funding for any company is because you have traction or some traction, or you have a past experience with an opportunity that you've done before and you just want to go after more quickly. And so those would be the two reasons why, is that you want to chase after the traction or double down on the traction that you're already seeing. You have more people trying to buy your product than you can make the product. You have people who are using, if it's software, they're using the software and there's lots of bugs with it and you need to iterate on the software faster. Or you're seeing that people are signing up and you say, "Oh, if we just added more marketing to this mix, it would accelerate what we're already doing." And so I look at raising early stage capital as an accelerant to whatever inkling or kindle of a fire that you're seeing or you've created.
Okay, so it's about acceleration. What would be your red flags for a company not ready to raise funding?
There's no hard and fast answer here, right? There are lots of people who are able to go out and raise a small seed round from friends and family or even angel investors without having a lot of traction. I always think that's a risky proposition because what happens is that until you find traction, your job will be raising money. So you go out and say you raise $500,000, and that $500,000, you say, "Okay, I want to get to the MVP." You build the MVP of your product, or you build the first version or whatever, you get the first lot of products ordered to your warehouse. And then what happens is you have to figure out how to sell it, right? You have to basically drive marketing. And if you didn't raise enough money to drive the marketing, or you just raise enough money to get that first lot, then you have to go out and raise more money to do the next set of work. And that treadmill that you get on, there are sometimes you want to get on the treadmill when you're in shape. Sometimes you don't want to get on the treadmill when you're not in shape. And so that would be a red flag. If you're not moving forward and you don't already have traction, it's possible to raise money, but there's much more risk to you as an entrepreneur and the success of your business, especially if you've never done it before, because what can happen is that you might not necessarily hit one of those checkpoints that you need to hit, and then you end up neglecting the product and the company itself to just raise money to get to the next checkpoint.
Okay. So can we talk about the difference between traditional and angel investors? What is a traditional investor?
Yeah. So when we say traditional investor, what do you mean, like a venture capital investor, or do you mean like a stock market investor?
Venture capital investor.
Okay. Venture capital investors, they run what's called a fund. And so their job is they go out and they raise money from people who have lots and lots of money. And their pitch to the people who they raise their money from as a VC is, I know this niche of startups. I built a direct to consumer brand and I sold it. And now I know all these different startups and I know how to pick them and I know what that market looks like, or I know software and I know what enterprise software looks like and I know how to pick enterprise software, and I have lots of relationships where I can help enterprise software startups grow. And so those VCs, what they do is they go out and raise money from what's called LPs, short for limited partners. And say, hey, you're already invested in the stock market, you're already invested in all these other assets. You should also be invested in high growth opportunities where your money potentially can grow faster if there's a big win. And venture capital investors, that's what they do. You have a responsibility to your limited partners. You give them a thesis and you can only invest within that thesis that you tell your LPs that you're going to invest in. There's a lot more structure and a lot more overhead to set up your own fund. With an angel investor, they're really just individuals who have some money set aside. So they might have sold a company, or they might have made some money in the stock market, or they might have an interest in a specific niche. And so they decide that they want to take the money that they've made as an individual and invest. And the good thing about angels is that they're usually more passionate and they're usually come in an early stage and they see more of the potential of a business versus the established business. And with angel investors also, they write smaller checks. Venture capital firms go out and raise money from 20, 30, 100 other people into their fund sizes. On the smaller end, they're usually like $5 to $10 million funds. On the larger end, they can be billion-dollar funds. And that range of venture capital firms, and then angels usually write checks in the range of $10,000 to $250,000, maybe $200,000. And they're usually coming in as like an individual into your company.
Yeah. And from my experience, for that reason, because it's just an individual versus someone who has come in with a thesis or a fund that has a thesis, pitching to them is also different. Pitching feels more like you're trying to speak to a formula when you're talking to a VC fund versus when you're speaking to an angel investor where you can really dig into your vision and your business as an individual business.
Yeah, I think the angel investors tend to be your first fans. If you're a musician, they're the people who came to the small show in the bar that you're playing. And so they're like, oh, I knew that artist before they were even a thing. That's the angel investor vibe, right? And you do want those because they are going to cheer you on. And, you know, they genuinely care about your company.
How do you, if you're trying to start out raising, how would you suggest you start finding people to invest? Would you go straight to angel investors, and how would you find out where the angel investors are?
Mm-hmm. Yeah, it's a great question. The most important things are, what are you going to do with the money, and how much money do you need to do what you want to do, and over what time frame are you actually going to do that? And that will ultimately determine who you raise from. So if it's a really big idea and you have to raise $10 million, which in most cases you don't when you're raising a seed round, But if you're in high-tech AI stuff, you might be able to go out and raise a seed round of $15 million because that's what they do. What you will have to think about is how much do we need and what do we want to do with that money? And so say you need to hire 2 or 3 people, or you need to go out and buy the first run of your product, and you need to do marketing around that product, and you might need to hire 1 or 2 of those people. That might require $2 million in funding. And so you have to get super clear on what that checkpoint is if you are going to raise that money. And so that's part 1. And then once you're clear on that and that timing, then what you'll start to do is there's kind of 2 places that you find your first investors, your angel investors. The first place is in your network. And that is usually the best place to start. People that you went to college with, people that you maybe have worked with in the past, potential partners, just people in your network. If you don't have a network, then you have to build one. And what that means is that you have to find people who you can go out and build trust with over some period of time. So when you start with your network, as you're fundraising, if there's someone who you decide, hey, what do you think about this idea? I'm thinking about raising money for it. It reduces the pressure from if you're friends or family, just, hey, I want to practice my pitch. What do you think? Like, just give me feedback. That reduces the pressure. And if people are really excited, then you're like, oh, maybe I do have something, right? Or if you are going out and you're giving, I say like it's, YGN, and you have, a head wrap and, people really love it, and you give it to your aunt or your cousin or like your lawyer, like somebody who really loves the product, and like, man, this is awesome. How are you making money? I'm like, there's lots of people who want it, but I'm just trying to get it up and going. I need this money to do marketing. I need this money for the next batch. And so that is the type of conversation that you would have with angel investors. Now, if you're setting up to do a proper fundraise from, larger angel investors or seed institutions, then you have to formalize the process a little bit. You have to start going out. If you don't already have the network, you have to start going out to networking events. You have to start to meet people. And the fundraising process in general, I've never seen it happen in less than 3 to 6 months. Just know that if you're going out and you're raising your first round or your seed round, and sometimes it even takes a year, and it's going to be a lot. You're going to get a lot of no's. You're going to get a lot of people who say they're interested but aren't really interested because they don't want to hurt your feelings. You're going to get a lot of people who say, oh, who else is investing? They want to see who else is going to be investing in your company before they decide to take the risk. There's a lot of those considerations, but it really just starts, I think if you're raising money for the first time, it starts with people who, if you don't know anybody, then you have to take the time to build relationships over 3-6 months or so, maybe even a year, honestly.
Yeah. For YGN in particular, you had come in with a bit of a network, but we really did a lot of cold email.
Yeah. Your angel investors should come from your network. And if you don't have one, you should build a network. That's it.
You came in with a bit of a network, but we also did a lot of cold emailing, finding people who would take a call. So going on their website and just sending out a cold email to their contacts and seeing who fit. And that's how we found the lead investor.
Yeah, I think it was either a cold email or through an intro. I'm not 100% sure. But you can go the cold email route. And there are lots of VCs who do take cold emails and they do vet them. Usually a VC will have someone who's reviewing the startups. If you're a VC and you're somewhat prominent, then you have someone who's vetting the startups. And I've never come across someone who's excellent at just sorting those startups. Usually like your cold email gets lost in some inbox somewhere. And so the goal really is to find how else can you connect with that person, whether it's at an event in person, stalk them on Twitter or stalk them on LinkedIn and try to show up where they're going to show up and try to meet them in person, or try to find who you know on LinkedIn who's connected to those people. There's this note of trust that you're always trying to build and always thinking about with those VC, any type of investor. And there are lots of really great stories about thinking outside of the box. So if you have a physical product, you can send them like a gift package, or if you have a software that does something, you can make it personalized for the VC. And so you just want to think about how are you going to get that person's attention and get them excited and say, oh, that was cool. This person seems like they're willing to go the extra mile. That's what I like in an entrepreneur. They're probably going to be successful. I think I want to bet on them. That's like what you're trying to find with them.
Yeah, I think that's great advice. And for me, especially as like a woman of color, that's the most difficult part is trying to get to those networks because for a certain network, certain levels of affinity, and you're not going to find a whole lot of people that look for, like you, those networks. But it's great to think about like where you try and connect with them and where you can find people to connect with and what type of events to go to in order to connect with. Now,
Yeah, another area that I think can be interesting if you're just getting started is finding an accelerator, a decent accelerator. Either there are lots of accelerators for people of color, those types of things. There's a point person in accelerators whose job it is just to interface with the startups and the companies that are coming in. And if you can build connections with those people and then also get feedback on your pitch, always be asking for feedback as you're talking to people. Hey, how can I do this better? Was there anything that's unclear? Where do you think I could fail? A lot of founders don't think they can fail and they don't think it's possible. And I think all they have to do is these three things and they're off to the races and they're going to be a unicorn. And that's not always the case. I think it is refreshing to anyone when someone comes and says how can I be better? How do you have any other feedback? Asking questions in ways that show that you're open to learning and you're open to growth and you're open to winning and figuring out the path to winning, especially when you're early on. And so I think these accelerators are a good way to just get practice and get the reps in of applying, maybe meeting someone, maybe doing a pitch, and maybe getting feedback. And so that's one alternate route. If you're in the accelerator, then potentially they give you some connection to somewhere else. And so I think that's another route or another path that you can, check out. And there are lots of them that you can, try to apply to.
So let's back up a little bit. What exactly is an accelerator and what would you do in that portfolio?
Mm-hmm. It's a great question. So think about a venture capitalist, and it's a model of deploying venture capital. Let's just put it that way. And so the accelerators model is fundamentally that we are going to find a cohort promising startups. We're going to give them some amount of money. It might be $100,000, $150,000. Sometimes it's a combination of services that you get when you join the startup accelerator and a combination of cash. And you're going to go through a cohort of, call it 12 weeks or 20 weeks with those other startups. And each week there'll be a different set of information that they give you about how to build your startup or how to get traction. They're essentially, it's like training camp for a startup. And there are different checkpoints and you have different check-ins on a weekly basis. And usually accelerators build up to what's called a demo day, a culmination of, what you've accomplished during the accelerator, that 12-week or 20-week period of time. And at the end of that, what they try to do is they try to leverage their connections. Whoever's running the accelerator, they try to leverage their connections to get angel investors. So they're vested in you because they have invested a certain amount. So they go out, they raise a bunch of money. It might be, if you have, they might be deploy $1 million per accelerator, right? And they might do it. They might say, okay, this is a 5-year accelerator. We've raised $10 million to do this. We're going to get a space. We're going to bring them, and we're just going to coordinate people in our network to come in and help these startups. And so we're going to take the startup from it's almost pre being ready for a seed and kind of build them up till they get to the point where they get seed. So when you come out of the accelerator, they want you to raise more money because they're also an investor in you. And so they're aligned with helping you succeed in the early term, but also hopefully after the accelerator, helping you raise money. And they also want to say, these companies came out of our accelerator and look how well they're doing. And that's like the purpose of accelerator. It's like a VC, but it's structured to give startups more hands-on help as they build.
Do they help you build your pitch as well, or does your pitch already set once you get there and then they help you build your startup?
Yeah, so usually they do help you build your pitch, and that's part of what an accelerator can bring. I've been through 2 or 3 accelerators over my career, and they are valuable in that you do learn things depending on the quality of them. The accelerator, I went to the Disney accelerator where Disney partnered with Techstars. I was in one back in the day called 500 Startups. And I also was in one that Puerto Rico put on when they were trying to bring startups to the island. And so they all have like different reasons for being, but the main thing is they do try to help you build your pitch. So when you are applying to get into an accelerator, the application process is like a bunch of questions, usually about your traction, usually about who you are, about your background, about your team. And they usually ask for either a demo video or a pitch video from you saying like why your product or your company is awesome and why you really want to be in this accelerator. And so the vetting process for getting into accelerator is somewhat, depending on the accelerator, it's not as rigorous as raising money. And then once you get into the accelerator, they will help you build your pitch and give you feedback on your startup and your traction and the product and all of those things.
How do you decide how much to raise for your startup?
This is much more of an art than a science in that, as I mentioned earlier, it is really important to decide how much it's going to cost you to do whatever you think you're going to do. And if it's order that lot of product, hire your first marketing hire at 70 grand a year or whatever that's going to be, and you're going to invest, call it 100K in paid ads or 100K in influencers, whatever that's going to be. You have to just lay that out and lay out your cost structure for the business. And then what you want to do is say, okay, if that cost structure is $1 million, then you want to have maybe 2 years of runway. You want to try to raise like 1 to 2 years of your projected expenses for your business. And say your cost is going to be 100 grand a month, or the cost to operate your business, which is also called burn, that's going to be 50K a month, right? So that's in over 12 months, that's $500,000. And say you're going to want to spend, call it 50 grand a month on Facebook ads. That's another $500,000. So that gets you to $1 million. And then you're going to want to have salaries. And even 70, say it's 5 people at 100 grand, that's another $500,000, right? And so that'll put you at $1.5 million to raise that round of funding. Operate the business as you see it for a year, for 12 months. And then you say, okay, maybe we want to have a buffer of another year. So let's go out and try to raise $3 million. Run the numbers, see how much you think it's going to cost you to actually run the business. And then you have to look at investors, seed stage investors, angel investors have certain bands of investment that they like to invest in from a valuation perspective. So how much is a company worth? There are a lot of investors who say, I don't want to invest in companies with valuations over $2 million. So that like eliminates some investors. So say you really want an investor, you might have to bring down your round size to bring on the investors that you want. Or you might have investors that say, hey, I really like this company, but I don't write checks that are smaller than $250,000 or $500,000. And I always need to have over 10% of the company when I write my checks. And so that will also force, if you have an investor you really like, and they know that they always want a 10% portion of your company when you're going out and getting investors, then you might have to raise the valuation to get there. And so that's really where the art is, that you think about how much you need to raise and have that in your head. I need $3 million to operate over the next couple of years. If I get that, that's great. And then there are also comps for the industry that you're in, right? D2C, direct to consumer, has lower valuations and multiples. A multiple is how the valuation of your company is defined by the market. Sometimes the multiple can go on profit. Sometimes it can go on revenue. So you might be valued at 2 times your revenue, or you might be valued at 5 times your profit. And so you have your valuation of your company. And so there's some industries where the valuations are sky high and you can get away with raising more money with much less. And it doesn't even matter what your calculations are to run the company. You can just raise a bunch of money because you're in a market that's white hot and everyone wants to bet on that in that moment. And that's what all the startups are raising at. That's what your potential peers are raising at. And so it just raises the bar for how much you can raise. And so at that point, you try to tell a story about the size of the market or what you're going after.
That's great. I love the idea of building your valuation based on how much obviously it's going to cost to get to where you need to go. And I also think that just leads into the point that the roadmap is so important when you're building your pitch, so you know exactly where you're going to go and you can build that valuation work.
Yeah, and I think the other reason why it's really important is that when you're pitching, investors see a million billion pitches a year. And so more than likely, they probably aren't as smart about your specific business as you are, but they are smarter about like where there are pitfalls around startups. And if you say, we're going to start today and next year we're going to be at $20 million in revenue, they're going to laugh you out the room, or they might just say, okay, great. And you won't hear from them again because what they know of the reality of running a startup is vastly different than what you think. And so they know that they can't trust what you think is going to happen. And you have to know that when VCs or angel investors, they see a lot of startups, a lot of companies. And so you have to be in line with that, because if you're out of line, you better have a really good reason for why you're out of line with it. And if you're not, then it just shows that you don't know what you're talking about. And it will do you more harm in raising money than good.
And I would think that would be most of the reason why it's important to have a really strong team with experience behind you. When I first started out, I had bootstrapped YGN, and I didn't know why you needed these people with this pedigree or these people with this background in order to have people really want to put their money behind you. But after doing it for a few years, it's clear that it's good to have someone around that has been there before and can tell you or can help you figure out what that roadmap should look like and what the exact goal should be and what a realistic timeline would be for your business.
Mm-hmm. Yeah, and honestly, most VCs will tell you this, is that the two most important things that startup or they want to invest in. The first one is team, right? Is what's your experience? What's your life experience? What's your educational experience? What's your career experience? And how will that help you not fail? Like the odds of failure are so high. So you're just trying to de-risk the odds of like failure. And VCs will say they look at your team first, and you have to think about, okay, like, who do I have on these slides that will signal to an investor, hey, this person has been at Microsoft, this person has been at Facebook, this person has raised money before, this person exited a company before, this person ran a factory before, this person came from like Nike before. Like, what are the things that like where you want to be, and like how does the people on your slides say that you're going to do what you're saying you're going to do, and that you have enough market awareness to know where the pitfalls are going to be. And then the second part is, generally speaking, the market. If you're in a market that is fairly small, we have to do this a lot with YGN, is justify the size of the ethnic hair care market, specifically the ethnic accessory or textured hair accessory market, because most people don't know how big the market is. And so you have to explain to them why it's a big market and how big it can actually be and why this is going to be a good outcome for the VC, right? For the investor. Because after all, their job is to get a return out of their investment. And so you have to explain to them and draw the line from, this is where AI is going. This is where Black women over-index by a factor of 7 for spending on hair care in the hair care market. And there aren't accessories out there for them. And we're already seeing traction. And so this is why we think that, over the next 5, 7, 10 years that we're going to return your money. And so part of that is your team. And the other part is, okay, this is the path that we're going on. And you need to be able to say it with confidence and credibility. So it's not like you can say it confidently, but it can be so outlandish that somebody won't believe you. But if you say, oh, this is where we think, and this is what's already happening, and we're going to draw these lines from here, and we have these people who are going to help us, or these advisors, if you don't have your team put together yet, we have these advisors, we have these partners already lined up who we're already doing business with. Those things bring more credibility and more heft to your story.
Okay. You've landed the call with your potential investors. You have strong team, strong advisors. You have a feel for your roadmap, your value. And what are the building blocks of the pitch that you should come to that call with?
It really does depend. If it's an in-person meeting, an informal in-person meeting, like say you're meeting up for coffee or lunch, so you have to and want to read the room, right? If it's, let's meet up for coffee or a drink and let's talk, you don't want to come with slides, right? And so you want to think about, all right, what's the nature of this meeting? And am I just talking to them just to talk and asking them about themselves and the type of companies that they invest in? And then you want to just have a conversation about, oh, this is what I'm doing. This is how I've been doing it. You want to stress on the why in informal meetings. Why am I doing this? Why am I passionate about it? Why am I excited about it? It's informal, so it's more of a conversation, right? If you're going to an actual pitch, an investor pitch, an angel pitch, then the slides should really be as short as possible. There's a investor, his name is Fred Wilson, and he's an institution, led the New York tech startup scene, and he popularized the idea that your pitch slide should only be ideally 6 slides, and you can't get the investor excited enough in 6 slides, then he's not investing, at least. Maybe there are other investors, but he's the creme of the creme. So he's going to say, if it's not exciting enough in 6 slides, and you can't do it, then it's going to be boring and I'm not going to invest. And so those 6 slides are usually a high-level opening, visionary idea of what the company does today. So I guess it's a tactical description that's easy to understand of what the company does and who it serves, right? We make the best quality hair accessories for the textured people with textured hair so that they protect their hair, they keep their hair healthy. And so that's the first slide, which is the intro slide. The second slide, most people will say, if you have a strong team, then you want to focus on that, right? If you have a strong team, what they say is you don't want to bury the lead. So you don't want to put the most interesting stuff at the end because people lose interest as the more you go. So if the most interesting thing is, I worked at Microsoft, I worked at L'Oreal, or I worked at Nike, then you want to come with that. And the team is just a baller team, then that's where you want to start, because ultimately people are like, oh, wow, okay, these people have something to say. I think I'm going to listen. If you don't have that, you want to focus on the pain in the market, right? So you want to move from intro to this is why this product matters. So let's do the big picture intro to, okay, people with textured hair represent 20% of the market, and these are the products that they're using as a substitute for keeping their hair healthy. This is where our product kind of fits, that solves that problem. So high level intro, then you want to go to what the problem is in the market. You might have 1 or 2 slides on that, and then how your product, your business solves that problem. And then you want to have some kind of overview. If they don't know the market, you want to give them the competition of, okay, who are you in relation to what else is out there? You want to have a slide about the market size. So how big is this market? and why should you invest. And then you want to have a slide about traction, or you can jump into some type of demo of the product if it's software. And then you want to have, this is how much we want to raise. And this is what we're going to do when we raise the funding and use of proceeds. And then the final slide is, this is going to be the structure of the fundraise. So we're going to raise $500,000, $2 million. We're going to do it on a safe or whatever, or convertible note or whatever. This is going to be the valuation of it. And then you have your closing slide. So that's the structure. You have your intro. If your team is great, then you lead with your team. If it's not great, then you lead with the problem in the market. Then if you go to what else is in the market right now, environmental, what's going on in the market, how your product solves the problem in the market, then you move on to, okay, this is the size of the market itself. And then you want to go into, all right, this is any traction that we have had to date, and this is how we're going to be playing in the market. Then you want to go into, this is how much we want to raise and why we want to raise and what we're going to do with it. And this is the structure of the investment. That's how you structure the pitch if you're pitching.
So you mentioned safe versus convertible note. For those of us who don't know what those things are, what the safe versus...
There are three ways that I know of that I can think of off the top of my head to raise venture capital today. The first one is a more traditional way to raise venture capital. It's called a priced round. So you just say, this is the price of the company. This is how much of the company I'm selling, 10%, 20%. This is how much we're raising. That's it. That's much harder for early stage companies because there's not really a valuation around it. There's nothing to value yet. So what you're trying to do is you're trying to de-risk on, there's like a lot of stuff that you're going to learn over the next year, 2 years, 6 months, whatever it is going to be before you get to the next round of funding. So from an investor side, you don't want to have too much of the business so that like when they have to go and raise their next round, that no other investor is interested, because like you have your first investor who's taken up a huge chunk. And from the investor side, you need to have some structure. So if it's not a price round and you're really early on, historically what they had was a convertible note. And so a convertible note is really, hey, you're going to give me this money. It's a loan. Technically, on paper, it's actually a loan. So if anything goes sideways, you still owe me the money, and there's some interest on that money that you invested in the company, right? So that's like a convertible note. And usually convertible notes, they convert, and that's why they're called a convertible note. When you raise your next round of funding, they will convert into equity based on the amount that you put in. So say you put $100K into the company, and at the next round of funding, you raise $2 million, then that $100K that you put in is worth 5% of the company at the next round because it converts into equity. And so the loan goes away, right? So like when a convertible note converts, the loan goes away and it's converted into equity in the company at the next round. And so that's like the structure of a convertible note. Now, historically been a challenge with convertible notes because startups are young, and when you're a startup, you don't necessarily want debt on the books, one. Two, the loans end up, because you're a startup, you're continuously trying to reinvest everything you have back into the company for the first X number of years of your company, 5, 10, whatever years. You don't want to have that money being paid back out to your investors. And if the investor truly believes in the long-term value proposition of you building the company, and they're truly aligned with that, then they also don't want to be drawing on the operating capital of the company. So Y Combinator came up with this new structure and it was called a SAFE. And the SAFE has like the same dynamics of a convertible note, but without it actually being a loan. So it says, hey, this is almost like a promise to convert this amount that you put into the company at the next round of funding, but it's not a loan. And so that is what a SAFE is, that it's like a placeholder for future equity in the company at a future round.
So how do you choose when you are, I guess you would choose based on the stage of your company and whether or not you can get a firm valuation.
Yeah, exactly. So usually the nice thing about SAFEs is that If you are an angel investor or you're a seed stage investor, it minimizes the paperwork for both you as a startup, and it's a known thing. So there's like a form safe, and it's okay, great. This is a safe. Everyone agrees that this is a safe. And it's just like a standard instrument now. And so because it's a safe, there's not as much due diligence around when you're investing with a safe either. And so I think more tech investors usually prefer safes, honestly, because, or not even prefer, they're more likely to invest in safes. Outside of tech circles, safes are less frequent if they might be, because say you're a real estate person and you're coming into investing in tech, you know loans and you know the structure of loans, you know how loans work and all those things. And so, and you also know valuations, because when you sell your company, there's a hard and fast valuation. So depending on the investor, an investor would say, I don't really like the safe thing. I'm confused about it. It's hard to understand. I'm not going to invest unless it's a convertible note or unless it's a price round. Usually when you start to raise even more money, once you get to your seed round of funding, it's probably 50-50. Sometimes you're raising on a safe, sometimes you're raising on a price round. Typically from the founder perspective, you probably want to put off valuing the company for as long as possible, because when you value the company, that's like a checkpoint. It's like, that's the scoreboard of what your company is valued. So whatever happens in the future, whether the traction is good or bad, whether it's, there are lots of things that could happen, your valuation will go up or down. And when you have a valuation, the investor gets priority if the valuation goes down. So what you sold the company for, that 5% that you sold the company for, if the valuation goes down 20%, you just sold off 7% instead, right? So as a founder, what you're trying to do is you want to avoid value in the company. That's why lots of startups are like, we're not going to go, when you go IPO, there's like a valuation on the market that says what you're valued. Until you go IPO, it's all funny money. You could be valued at whatever you want to say you're valued at. And if you get some investors to invest that valuation, that's what we agree it's valued at. But when you go into the public market, you're really valued and the markets will say what you're valued at. And so I think that's why companies want to put off valuing their company for as long as they possibly can and continue to build the story and continue to build attraction until it's ready and you're confident. All right, this is an airtight company, airtight story. My valuation could be way higher when I know a lot of information and like things are going good and I have lots of traction than when you don't know a lot and everyone's just taking a guess.
So you've got your pitch, you've got your evaluation. What are some of the challenges that a company faces when they go out to?
Yeah, I think surprisingly, you think, okay, the hardest part is raising the money. But when you raise money, it's a full-time job. And your focus, you're almost doing two different jobs now, is that you're still running your company and you're constantly going out and finding new people to invest and having these conversations with these people. And as a founder, you're getting this market feedback that may or may not be relevant to your business. And you're still operating it. So you might go out and you like have a really focused roadmap and you're doing all this stuff and you're attending to your customers and investors. What about this market over here? Or what about this competitor over here? Or I would invest if you got this thing, if you landed this deal. And so it can be distracting as a founder to raise and operate your business because you start like conflating your investor story with your product and customer story. And you go back and you tell your team, hey, can we do this thing? This investor said that they would invest in us. And your team's going back and forth and they're getting confused. And so that is the biggest risk to a company that has traction, I'd say, is you have to commit to almost like stepping away from your company to mainly raise the funding and stepping down your involvement to like 20 to 30%. You want to be on top of everything. You want to be out. You want to be networking. You never know where that one connection will lead to that next investor. And you also want to be generating the demand in the market, because investors talk to each other and they'll send a deal to someone else. A lot of it is marketing. So like you talk to one person, they might forward you on and say, hey, I saw this interesting. What do you think? And you might want to go talk to that person. And so they'll talk, or I saw that person at an event last week, or I saw them on PR. Oh, I think like they followed me on social media last week. So you're out like doing, it's almost like you don't hear anything from Beyonce until she's about to go on tour, right? And then all is Beyonce everywhere on late night TV. There are all these stories that come out about her. Like all this stuff happens, right? But you don't see anything, you don't hear anything from her for a year and a half. And so that's what fundraising is. Okay, now we're out. We're outside. We're talking to everyone. And we're generating this buzz now about the company. But you're not in the studio making the music anymore. You're out of the studio. It's already, you're just out promoting what you just made. And so that's the process. And I think that's the biggest risk. And it's really hard to do. I don't know many funders that actually get it right, who are actually operating founders. There are some CEOs who are just really good at raising money. And that's all they do is they know how to raise money. They know how to build a team, and they know how to like drive that process forward. And there are operating CEOs. And I think when you have your hands in it, it's really hard to be like, all right, I'm going to go talk to this person who might not necessarily know as much as I do, or asking me these questions that like, and you're just asking many people, and 1 out of 10 or 0.1 out of 10 or 0.5 out of 10 will actually say yes. Just like dealing with the rejection on a continuous basis of people who aren't necessarily as keyed in to your specific of what you're doing, and kind of taking their advice or just hearing them and still saying, I still want to continue to build this relationship, even though you said no to me. I'm going to like continue to build a relationship so that you invest down the line. So I think those are really the two hardest things about raising funding. If you can do those things, if you can do those two things, one, kind of say like, all right, I'm just going to go out and raise. We're going to be focused on raising money. We're just going to do that. And two, in spite of an investor saying no, and lots of investors saying no, it's still my job to continue to build the relationships with those investors over time, so that they don't, at some point in time, they want to reinvest, or there's another round, or you're building the trust with the traction that you're having with your company to raise in the future.
Yeah, and I'd also add that not to be stated that raising money is a whole other job. Create the space in your time to do that, especially if you're a CEO and you're very on CEO, like I was, really difficult at the same time. Um, but also, I would say once you do get a yes, also betting your investors, knowing that you guys are going to be a good match for the long run once they're in and they put a check in. You want to make sure that this is the type of the investor that you want to be involved with for the long.
Mm-hmm. Yeah, I think when you're early on, you don't necessarily have that luxury, but an investor is another partner. And so you inevitably will negotiate with your investors when you're raising funding. And if they're a pain in the butt when you're investing, it's like any relationship. If there's something weird, is a
Red flag.
red flag. Look for those red flags with your investors for sure. Because if you heard from somewhere, someone else said, oh, they did that thing to me and that wasn't cool, red flag. Or if they're fighting with other investors, or they're talking trash about somebody else, there are red flags about investors that say, even if they have the money, even if they're willing to write you the check, if your job is already really hard as a founder and you don't want somebody making things harder when things go bad, that's like the worst. And so those are the things that you also want someone who's going to be your cheerleader in a lot of ways, and in respectful ways can give you feedback. And I think that balance is one where sometimes like you just have investors who want to talk, and like about like they just want to talk, right? And where that's valuable, it has to be filtered for you as an entrepreneur. An investor might want to introduce you to somebody, and like you're busy, And they might want to introduce you to 10 people and say, hey, like, I know this guy who does marketing. Want to go talk to that person? And you like trust your investor to say like, yeah, I trust my investor's judgment, but that other guy like is their friend or they don't really know anything. So you want to just, the quality of your investors, it does matter. You don't always have the choice. Sometimes you just need to take the check, but it will have implications around your business. It also is a signal potentially to future investors of who's in your company. So if you go out and try to raise more money, investors are going to be like, oh, who else is invested in the past? It's the same thing with having a team. And so if you have people who invested in the past that aren't like, if they don't know about them or they don't have a reputation, then it's a signal that you couldn't raise money from people who are known. And that's fine. But those are the trade-offs of taking investment from people who don't have a reputation. All of this, as you're building your company, is all about brand. And so brand is association, brand is story, and brand is, with YGN, we think a lot about like our visuals. So as like your fundraising story, what are the optics around that? Because ultimately, most investors don't have anything else to go on but their gut and their optics when they're investing in you in your early stages. They're just making a bet. I like these guys. I think they can do something. And like they're looking for these signals to either not invest or positive signals that they associate with to invest.
Before we close up the conversation, I want to talk about, you closed your round. What should your investors expect next?
Communication, for sure. So definitely ongoing communication about your progress and how you're doing. And usually it's like a few lines about, okay, like this is what we did. This is what we're planning on doing this month. This is what we're planning on doing this quarter. And that's definitely the best practice around it. Every investor says that startups, even at YGN, we're not the best at it. We can definitely be better about it. Your investors are just looking for communication. They're looking for you to use them and use their connections. So the more you can show up and say, hey, can you help me out with this? That's like how they want to be able to say that they're being helpful. They're looking for you to be honest and transparent. So if things are going sideways, you want to be able to tell them. There is a delicate balance between, from a startup perspective, of freaking out, I don't know what to do, I feel like I'm going to fail, and telling your investors that, versus like, all right, this is a challenge. These are some of the good things that are happening, and this is the thing that we're trying to figure out. I always try to like deliver both good and bad news together, and what our plan is to like solve whatever challenge we're facing, or this is what we're learning. And I think that's important. And investors always want to feel or see progress, because they see so many companies. They know what traction looks like, and they know what negative traction looks like. And so it's hard to manufacture that, especially as you're continuously communicating. There's going to be a point like, okay, like what's next? What are you guys doing next? When you raise money, it's now time to make your company more valuable tomorrow than it was today. And then that's on you. So there's this saying, when you raise capital, don't wish me congratulations, wish me good luck. Because that only means you got to get to the next checkpoint. Capital frees up a lot of constraints that you will have as a company potentially, but also you get on a treadmill to continue to grow if you want to raise more funding. And if a year from now you don't have traction, then it's going to be really hard to raise funding. And if you were operating the company as if you were funded and you can no longer raise funding, then you either got to figure out how to make the business profitable so you can keep on running it, or you have to go out of business. And so that's a risk, is that you have to be sure. That's what investors are looking for. Your present investors are looking for your traction, and your future investors, even more so, are looking for your traction. And so that's something that once you raise that capital, focus on communicating with your investors, using them as resources, asking them, hey, do you know of anybody? Are you seeing any companies that are doing this? Can you connect us with anybody? Oh, I noticed in your LinkedIn you have that. If you hear of anybody, I want to meet these types of people. We're looking to hire these types of people. Those are the things you want to ask your investors for. And then finally, you got to show traction. That's your job now as the CEO, is to show that traction so that you get to the next checkpoint. You can raise more money, and your present investors feel like their investment is worth it, and your future investors feel like they're worth it. Yeah, that.
Great. Thanks for that. That was such a thorough conversation about investing from starter about. Oh, do you have anything else you want to add?
No, I think that is, it's like I said, we talked about it before. It's really hard to know what it's like before you're actually in it. If you have questions, as we always say, hit us up at natureofthebusiness@yougonatural.com. And I'm happy to answer questions. So drop me a note. And yeah, good luck if you're raising funding.
Awesome. Talk to one next.
Thanks, guys.